While trade policy and big tech are dominating markets today, we have to touch on the economic data that we got this morning as well. First quarter GDP revisions showing the economy contracting at a slightly less severe rate, shrinking by 0.2% compared to the 0.3 we saw last month. For more on this, I'm going to bring in my co-host for the hour. We've got Paul Gruenwald, S&P Global Ratings Global Chief Economist, and also joining us to discuss, we've got Julie Biel, Chief Market Strategist and Portfolio Manager at Kayne Anderson Rudnick. I want to start with my co-host for the hour, Paul. Great to have you. Talk to me about how you are viewing the totality of the economic data we got this morning.
Yeah, well, let's start with the GDP. The big number, as you said, was unchanged. It's still slightly negative. There's two big pieces that kind of moved in opposite directions. The first one has to do with front running of the tariffs, because remember that story? We pulled in a lot of imports and they were stocked. Yeah. So we got a little bit of inventory uplift, which was good. But then we had a more serious, I would say, downward revision to consumption growth. Yeah. So 1.8 to 1.2 is a big move. 1.8's kind of soft landing territory. 1.2 is a little bit harder. So that's negative. We'll have to wait for the future revisions. But I think the takeaway is Q1 looked a little bit softer than we thought originally.
And Julie, to bring you into the conversation, to Paul's point, it seems like that softness in consumption data might have been on the bond market investors' minds this morning. What does that signal to you about risks to stocks if we do start to see a softening in consumers consuming?
Yeah, I think so much of what we can really attribute to the growth that we've enjoyed for the last 2 years has been on the backs of the strength of the consumer. And that's really been tied to the health of, economic gains that we've seen in jobs. What makes me a little bit nervous is when I look at some of the economic data, you're seeing more and more people choosing to do gig economy work. And I worry that that's actually the work that's the weakest in an economic situation, right? Suddenly Uber rides are not as important. Suddenly you're not door dashing quite as much. And so if we hit a patch where there's a weakness in consumer spending, I worry it has a duplicative effect on, the ability for people to kind of continue to find income as prices continue to go up.
And of course, the impact that can have on earnings growth going forward. Paul, bringing you back into the conversation here, where do you see the American consumer today?
Yeah, well, she made a very good point. It's really the consumer and the labor market that are put together. Since the Fed and other central banks started to raise rates, we've had this really resilient nexus of labor demand and consumption. If that cracks, and it hasn't cracked yet, but we've got some weakness. If that starts to crack, I think we go into a down leg with weaker growth. Labor market was okay today. We had a little bit of an uptick in claims, ongoing claims a little bit higher, but we're nowhere near the panic zone. So if this is a soft landing, which was the original call this year, we're okay, but we're going to have to watch the data for the next couple of months, consumer spending and the labor market.
Let's talk about the labor market a bit, because it also seems that it's taking longer for people to get jobs and that entry-level work is getting increasingly challenging to get. How concerned are you about that?
Well, we saw two things. We don't see a lot of layoffs, but we also don't see a lot of hiring. So that kind of, quits and new hires things kind of softened up a bit. It looks like firms are on hold. We've got all this policy uncertainty. The ruling last night by the court on the IEPA might be a little bit of a boost, but we still have this overhang on everything. So that's actually what we're watching. Right, if people start to move away from the discretionary spending, which is the first crack you would see, then what's in that bucket? Is it eating out? Is it travel? Is it, DoorDash and things like that? So we'll watch that kind of consumer discretionary bucket first. The essentials are probably going to go through any kind of slowdown, but the discretionary stuff is really where we'd start to see the delta.
And Julie, bringing you into the conversation from a markets perspective, the market has already gone back to its pre-Liberation Day highs this year. Where do you see stocks heading if the tariff headwind is removed? How big of a catalyst might that be, or is that not necessarily the next big thing to boost this market?
I think for the most part, the uncertainty has been the much bigger issue in terms of what's been driving the economy and the stock market. And so my real question is less about whether tariffs have an impact, yes or no. It's more a function of, do businesses feel they have confidence to make kind of longer term decisions? And so the data that I'm paying the most attention to now is CapEx, because so much of CapEx growth that we've had for the last 18 months has really been driven by AI and the hyperscalers. You want to talk about customer concentration. We're like counting on 5 or 6 companies to drive a lot of the CapEx growth. If we see other industries starting to feel more confident that they can do long-term planning, that the tariff overhang is going away, that is a good sign. That's good support for the economy. And if we can get a broadening of CapEx growth, I actually think that gives you longer-term better fundamentals.
And to your point on uncertainty versus certainty, we have the new taco trade headlines coming in, the idea that Trump always chickens out when it comes to tariffs. How much faith should investors have in that idea driving their investments?
Well, it's concerning, right? Because unfortunately, we told Donald Trump that we have this taco trade. And so I worry a little bit that actually makes him bear down a little bit more and decide to be more, more gripping on some of these tariff trades. And so I have a little bit of a concern that creates actually more uncertainty. But, for the most part, that's worked quite well for a lot of investors. They've been able to take advantage of that. And I think that actually connects to a lot of, former trades where it was, buying the dip. A lot of people don't want to be caught out on these big moves upwards. Mm-hmm. And so I think you'll continue to see volatility around that because there's so much still uncertainty. And the thing is that the policy changes, they change so quickly and they change immediately, right? They take effect almost immediately. So we continue to kind of see the level of uncertainty as being an overhang for probably the rest of the year at least.
And Paul, bringing you into that as well, I wonder how you're thinking about the data going forward after we did get this ruling that potentially slaps down some of these tariffs going forward. Can we trust the data when we don't know where tariffs stand?
Yeah, well, Julia made a great point. It's really this overhang of uncertainty that's putting a damper on investment, M&A, and we're seeing it in the sub-investment grade stuff as well. But yeah, we've got the court ruling, but if you listen to the administration officials this morning, there will probably be appeals. Maybe they can define other venues. Congress is supposed to be putting tariffs on anyway, right? So we could actually see possibly a shift to that. So I don't think this is the last word on tariffs, but I agree. This is a roller coaster ride, not good for long-term planning and not good for corporate investment.
Certainly. All right, Paul, thank you so much. You're going to stick with us. Julie, thank you so much for joining us. Really appreciate it.